Awesome. All right, so these are our experts, everybody. And here's a quick look at the agenda that we're going to be covering today. I'm going to lead off with a little bit of a review of the funding landscape and just some news headlines relevant to the folks in the room here, affecting fundraising in Canada today. Then we will move on to understanding the differences between seed and Series A and what you need at those different phases to kind of go about fundraising or even go talk to investors and what goes into your capital strategy at that phase. Then we're going to talk about the capital raise journey and then end it up with avenues for securing capital. Yeah, but to start up, like I was saying, before we dive into the discussion, I just want to give a quick primer on some of the realities, especially in Canada today. So you've likely seen the headlines around Budget 2024, which has been divisive for numerous reasons. On the one hand, the government has continued to make funding pledges for innovation spending, including investments into quantum computing and AI research initiatives, as well as a commitment to further SR&ED consultations in an effort to streamline and improve the government's banner R&D tax credit program. I will go deeper onto what SR&ED is and the nuances there later on in the chat. But the big headlines out of Budget 2024 have been related to the new capital gains inclusion rate, which the federal government plans to boost from 50% to more than 66% by June 2024. While this higher inclusion rate is estimated to raise almost $20 billion in revenue over 5 years for the government, the impact on the VC and investment communities could be significant. I'm not going to dive too deep into the divisive news on that front, and we'll let the experts in the room who are more involved in the VC space comment on that. But it speaks to larger funding initiatives and also budgets on the provincial level across Canada. Long story short, everyone is tightening their budgets. Everyone is tightening their budgets. Quebec, for instance, is rebalancing the refundable and non-refundable portions of their banner Electronic Business Development's tax credit, the CDAE, as well as their multimedia tax credit known as CTMM. For CDAE in particular, Quebec will be scaling up the non-refundable share, that is, credits where businesses must pay tax to Quebec to qualify, from 6% today to 10% by 2028, while scaling down the refundable share to just 20%. This will ultimately reduce the total generosity of these programs, which cost the provincial government almost $850 million in 2023. Similarly, in Ontario, while the province didn't restructure their tax credit programs outright, the latest budget was noticeably light on new funding programs. So, what's the big takeaway here? Put simply, government cash reserves are tight. As a result, any government funding like tax credits are going to be doled out with greater scrutiny than maybe ever before, which means that folks can anticipate more audits as they file this year and going forward. I will talk about how Boast can help you there later on in the conversation. But zooming out, what all of these colliding and commingling factors mean for seed and Series A businesses is that they need to be leveraging a diversified capital strategy to achieve growth and scale. That means tapping into VC funding, but also looking to other sources of capital, from those government resources I mentioned earlier to crowdfunding, that can help extend your runway, provide a bit of cushion against market fluctuations, and really set your teams up to continue innovating even if the revenue has yet to be a part of your capital strategy to date. And that's exactly why we have this group here today. So while all the attendees here have more or less self-identified as living within that pre-seed or Series A round, I'd like to pull our experts in to clearly define what sets businesses apart at this stage versus others in the startup lifecycle. So before we dive in, Daraj, I'd love to throw this at you to kind of kick things off. Could you tell us a little bit about the difference between seed and Series A, both from kind of an operational perspective and also just company maturity?